Hi guys, back again. So beginning chapter 15, and this is class number 25. I will mention at this point that we're only going to have one more class after this one. So that will then be it for the term. So today we're going to be talking about deductions for profit-making non-business activities. We've been talking up to this point about section 162, dealing with business expenses and the deductibility of those expenses. And now we're going to be talking about section 212, which allows a deduction for non-business expenses. So it's the non-business counterpart of section 162. In the case of Higgins versus Commissioner, Higgins had a lot of investments in real estate, stocks, and bonds. He sought to deduct those expenses that he incurred in managing the investments. The service conceded that the management of his real estate activities constituted a business, the expenses of which could be deducted under 162. But the management of the stocks and bonds was where Higgins and the service parted ways. Higgins argued that he spent a considerable amount of time managing his stocks and bonds, and that he even maintained an office to do this. In fact, his stocks and bonds occupied so much of his time that he was in a different situation, he argued, than a smaller investor, and therefore he should be considered to be engaged in a trader business because of his extensive investment activities. But the service said no deal. Mere personal investment activities never constitute carrying on a trader business, no matter how much of one's time or of one's employees' time they may occupy. And the Supreme Court agreed. So Higgins gets no deduction for his expenses incurred in generating his substantial investment income, except for his expenses incurred in connection with his real estate business, because that was considered a trader business. Now, you will note that this is a 1941 case. Mr. Higgins, as a wealthy individual, kicked up a big stir over losing his deductions. So the year after the case was decided, Congress enacted Section 212, which I mentioned before is the non-business counterpart of 162. Section 212 allows a deduction for the production or collection of income, but it retains the ordinary necessary terminology and the fact that the expenses must be expenses within the definition of Section 162. So therefore, no deduction for capital expenditures or personal expenses. As the text states, the production or collection of income language replaces the 162 trader business concept. Now, one thing I want to mention to you, we'll be talking about this some more in some of our remaining classes. Sections 162 and 212 are authorizing provisions. So they tell you that your expense is authorized under the code. However, the fact that the expense may be authorized does not necessarily mean that you will actually be able to take it. Clearly, if you do not have an authorizing provision, then you may not take the deduction. So if you don't have an authorizing provision, you're SOL. However, if you do pass the authorizing provision test, then you must determine how you take that deduction. Now, remember, we've referred several times in this course to above the line and below the line deductions. Well, if your authorized deduction falls within Section 62, it's an above the line deduction and you will be able to take it. But if it does not fall within Section 62, by definition, it is then a below the line or itemized deduction. Itemized deductions are deductions that you take if they collectively exceed your standard deduction, and we'll be talking about that in our last class. Since the standard deduction has been raised under the Tax Cut and Jobs Act of 2017, it's harder to itemize deductions now. and that raise continues through 2025. Now remember, I also told you that itemized deductions may be further limited. Well, Section 212 is one of those limited deductions because if it does not fall within Section 62, it will be considered what's called a miscellaneous itemized deduction under Section 67. So to state that a bit differently, Section 212 deductions may either be above the line under Section 62, or they may be below the line as an itemized deduction. Before the Tax Cut and Jobs Act, miscellaneous itemized deductions could only be taken to the extent that they exceeded a floor of 2% of your adjusted gross income. After the Tax Cut and Jobs Act, they may not be taken at all through 2025, and that's under Section 67G. Now, another thing about Section 67, you have to be careful in reading it. Under subsection B, the term miscellaneous itemized deductions means the itemized deductions other than the following listed deductions. So in other words, if you do not see your authorizing provision listed there, then it is considered a miscellaneous itemized deduction. So since 212 is not listed here, it is a miscellaneous itemized deduction that cannot be taken, at least not below the line. Now, let's talk about the case of Bowers versus Lumpkin on page 437. Mrs. Lumpkin was left some valuable stock in trust upon the death of her husband. The remainder of this stock had been left to a charity. Mrs. Lumpkin purchased this remaining stock, and the Attorney General of South Carolina instituted a suit to invalidate the sale and to require Ms. Lumpkin to account for the profits. Mrs. Lumpkin incurred expenses in successfully defending her title to the stock. She sought to deduct these expenses under Section 212, and this deduction was denied by the service. On what ground? The service argued, and the Fourth Circuit agreed, that the expenses were not ordinary necessary expenses, but instead were capital expenditures as acquisition expenses. The service had argued that these expenses did not relate to the management, conservation, or maintenance of property held for the production of income, but it instead related to Mrs. Lumpkin's acquisition of her stock. The Fourth Circuit stated in the last paragraph in the opinion on page 440, expenditures incurred in defending or perfecting title to property, in recovering property other than investment property, and amounts of income which, if and when recovered, must be included in income, or in developing or improving property, constitute a part of the cost of the property and are not deductible expenses. In the case of Saraski versus the United States on page 440, Mr. Saraski purchased a large amount of stock in a corporation with the intent to improve the company and greatly enhance the value of the stock. He formed a committee to advocate aggressive changes in the management of the company. This committee sought to elect a new board of directors in order to obtain increased dividends and a stock split. Saraski was not an officer, director, or employee of the company and did not seek a position as an officer, director, or employee. While the committee's actions were unsuccessful in replacing majority of the board of directors, its goals also ultimately were successful because it did not end up replacing some of the board. It did end up replacing some of the board, and almost immediately after that, the chairman of the board and the president of the company resigned. Afterward, the sales and earnings of the company increased. Zaraski had incurred substantial expense in mounting a proxy campaign in order to accomplish these goals. He sought to deduct his expenses under Section 212, but the service denied the deduction. The trial court held in favor of the government, opining that the expense was too speculative to establish the necessary relationship between the expenditure and the production of income or the management of income-producing property. But the Fifth Circuit thought the trial court required too difficult a showing of proximate connection than was required by the statute. It noted that nothing in the statute expressly requires a showing of a proximate relation to the production or collection of taxable income. This is on page 444. Instead, the Fifth Circuit thought the test should be whether the expenses are genuinely incurred in the exercise of reasonable business judgment. It noted that Zaraski, in incurring these expenses, had a reasonable likelihood of success, and that his expenditures did produce direct and tangible results. Profits were increased, dividends were increased, and the stock was enhanced in value. The court also noted that the expenditures were made to protect Zaraski's investment. Therefore, his expense deduction under Section 212 was allowed. In Revenue Ruling 64-236, the service acquiesced in the Zaraski decision. That means that it agrees with that decision and will follow that decision. In the case of Fleshman versus Commissioner on page 446, Dr. Fleshman was in the process of getting a divorce. He incurred expenses in defending against his wife's lawsuit to set aside their antenuptial agreement. The tax court held that those expenses are not deductible. Why not? It held that the expenses were capital in nature because they were in defense of his title to his property. It discussed the Gilmore case on pages 450 and 451, in which the Supreme Court, under similar facts, stated that the deductibility depended upon the origin and nature of the claim giving rise to the legal expenses, rather than upon the consequences of such a claim to income-producing property. The Supreme Court also stated that the term conservation of property refers to operations performed with respect to the property itself, rather than the taxpayer's retention of ownership of it. The characterization of litigation costs as personal or business depends upon whether the claim involved in the litigation arises in connection with a profit-seeking activity. This is on page 451. A claim against property in a divorce suit arises only from the marital relationship and is therefore personal in nature. In the Ruth K. Wild case, discussed on page 452, a wife was allowed to deduct her legal expenses related to alimony. Why? Because alimony at that time was included in the recipient's gross income under Section 71. Note that has been changed by the Tax Cut and Jobs Act of 2017. As we saw earlier, Section 71 no longer includes alimony in gross income, nor does it allow a deduction to the payor. Let's take a look at the problems on page 454. Remember that the Tax Cut and Jobs Act has changed the way that we now look at these expenses because miscellaneous itemized deductions are no longer deductible from 2018 through 2025. In A, on page 454, let me get to 454. Okay, So problem A, speculator buys 100 shares of Sound Company stock for $3,000, paying her broker a commission of $50 on the purchase. 14 months later, she sells the shares for $4,000, paying a commission of $60 on the sale. Are those commissions 212 expenses? Well, so speculator would not want to treat these expenses as 212 expenses because he would get no deduction for them. But since these are expenses that are directly incurred to acquire or dispose of income-producing property, they are in effect deductible because they adjust the adjusted basis or the amount realized. Under Spreckels, commissions paid on the purchase or sale of the stock will decrease speculator's amount realized on the sale or increase her adjusted basis on the purchase. So when she purchases the stock for $3,000, her $50 of commission will be added to her basis, so her basis will now become $3,050. The commission of $60 on the sale will reduce her amount realized to $3,940 to produce a gain realized of $890. Note, though, that the commissions paid by a dealer in securities as a selling expense may be deductible as an ordinary necessary expense under 162. Also, if the expenses fall within a Schedule C on a Form 1040, they are deductible from the Schedule C income. So Schedule C relates to profits and losses from unincorporated businesses, but it does apply to pass-through entities such as LLCs. So problem 1B, again under Spreckels, the commission was added to speculator's basis, so the basis is now $3,050 just as it was in problem 1A. The $45 commission again reduces her amount realized, so her $2,500 amount realized would now become $2,455, producing a difference of $595 as a loss. Now that loss could be recognized under Section 165A and C2 as a loss incurred in a transaction entered into for profit. This would be deductible above the line under Section 62A3. So if you're selling any stock in this economic downturn, the good news is that your loss will be fully deductible. Now, this will depend on the value of her holding in C. So looking at C, where speculator owned only 0.1% of the Sound Company stock worth $3,000, but being an eager investor during the time she owned the stock, she incurred $500 of transportation, meals, and lodging expenses in traveling 1,000 miles to New York City to attend Sound's annual shareholder meeting. May she deduct her costs under Section 212(2)? Well, so that depends on the value of her holding. If it's a small holding or minute holding, her expenditure would not be considered an ordinary expense because this would be a substantial cost in proportion to her investment. If the company is publicly traded, however, then the expense may be reasonable and ordinary under Saraski and Revenue Ruling 64-236. In D, what result in C if instead speculator owned 10% of the total outstanding Sound stock worth $300,000? Well, then the expense should fall under Section 212, provided that speculator can show a legitimate investment interest in attending the meeting. If she incurs the expense merely to decide whether or not to make further investments, then it is not within Section 212. And 2, after reading the Fleshman case, consider in what situations payor spouse may deduct attorney's fees incurred in getting a divorce. In general, a payor spouse's attorney's fees incurred in getting a divorce are considered personal expenses and are not deductible. But the Carpenter case, which was cited in Fleshman, says to the extent the legal fees are related to the tax aspects of a divorce, the deduction may be allowed under 212(3). The commissioner requires a fairly strong showing of allocation, though, of legal costs to tax advice. Note, however, that even if these deductions are authorized under 212, they are miscellaneous itemized deductions that are not allowed in computing a taxpayer's tax liability or taxable income through December 31st, 2025. This is under sections 67B and G. 2B, consider to the extent that a payee spouse, to what extent a payee spouse may deduct attorney's fees incurred in getting a divorce. Well, a payee spouse may deduct attorney's fees incurred in getting a divorce to the extent those fees are attributable to tax advice, just like the payor. And again, this is the Carpenter case. If the divorce involves payments under a pre-2019 divorce instrument, the tax court in Ruth K. Wild properly held that the payee spouse may also deduct attorney's fees incurred to negotiate that spouse's alimony payments, because alimony is income under Section 71 at least through 2018 to the payee. So the attorney's fees would then be considered Section 212(1) expenses incurred for the production or collection of income. From 2019 on, though, as of January 1st of 2019 through December 31st, I think that's a permanent one. So from January 1st of 2019 on, then alimony is no longer considered taxable income. Now, if the payments are made under a post-2018 divorce instrument, sections 71 and 215, as I said a minute ago, are inapplicable, as is 212(1) in this case. So the payee who previously could deduct attorney's fees only under 212(3 to the extent they are attributable to tax advice can no longer deduct that expense, because this would be considered a miscellaneous itemized deduction, which is not allowed until 2026, even though that deduction is authorized still under 212(3). Section B deals with charges arising out of transactions entered into for profit. And here we're looking at the case of Horman versus Commissioner on page 455. Mr. Horman inherited a house from his mother. He moved into it a few months later and used it as his personal residence. He then decided, though, it was too large for him and too expensive, so he abandoned the house as a residence and put it up for sale or rent. The property never rented, but it sold almost 3 years later. The issue here was whether Horman could take depreciation deductions on the house while it was on the market, whether he could take a deduction for expenses he incurred for maintenance and conservation of the property, and finally, whether he could take a loss on its sale. The tax court held that he could take a depreciation deduction on the house because the property was held for the production of income, since he abandoned the house as a personal residence and made continuous efforts to rent, even though he never received any rental income, and even though he was at all times also trying to sell the property. Likewise, he's entitled to deduct his maintenance expenses because, again, the property is considered held for the production of income. So in other words, Section 167A2, the depreciation deduction provision, and 212.1 have the same language, that the property must be held for the production of income. With respect to the loss on the sale of the property, though, the court notes that this would fall under what is now 165C2. So it would be considered a loss incurred in a transaction entered into for profit. So the first problem here is whether there is a transaction entered into for profit. The only transaction entered into by Mr. Harmon after he abandoned the property as his personal residence was the sale of that property. Since that sale was at a loss, it does not satisfy 165C2. The court states on page 457, if an owner rents, his decision is irrevocable, at least for the term of the lease. And if he remodels to fit the building for business purposes, he has likewise made it impossible to resume residential uses by a mere change of mind. When, however, he only instructs an agent to sell or rent the property, its change of character remains subject to his unfettered will. He may revoke the agency at any moment. The court goes on to say that an actual rental of the property is not always essential to a conversion. But here, since Harmon engaged in no transaction for profit, his loss deduction is not allowed because the loss is considered personal. Note that today, the loss deduction, if it had been allowed, would have been the only thing that Harmon could have taken advantage of, since it falls under Section 62A3 as an above-the-line deduction from a loss incurred in the sale or exchange of property. The 212 deduction would be a miscellaneous itemized deduction that's no longer allowed until 2026, and the depreciation deduction would only be allowed to the extent of income from that property. The next case, Lowry versus the United States, on page 458. Mr. Lowry had a summer house on Martha's Vineyard, which he decided to sell. He immediately put it up for sale and never again used it for personal purposes. He did go to the house each spring to open it, clean it, and spruce up the property. This took about 2 to 3 days. He would then return the following fall to close the house. He made no attempt to rent because he believed it would be easier to sell a clean, empty house than one occupied by tenants. Also, he said if he rented the house, he would have had to furnish linen, silverware, blankets, recreational equipment, etc. And the cost of all that would not have been justified for just a summer rental. Also, rental prices bore no relation to the value of the property, and there were also restrictive covenants against rental. So the issue here was when and how does residential property become converted into income-producing property? The district court, on pages 460 and 461, notes the tax court guideline is a bona fide offer to rent. Now, the district court said there's 3 reasons why the tax court requires a bona fide offer to rent. 1, the court said it stemmed from a fear that if the property was only offered for sale, the taxpayers would countermand the listing for sale after taking a series of deductions and then reoccupy the house on a personal basis. 2, the rental provided a clear and convenient administrative test. That is, it's an objective test. You either rent or you didn't. Third, the rental requirement had some implied consent in the regs at section 1.212-1H, which specifically mentions the property being held as rental property. In the case of Hewlett P Smith, the tax court held that the abandonment of the property for personal use, plus an offer for sale, transformed the property into an investment asset. But then 3 years later, the tax court abandoned that position in the case of Frank A. Newcomb by stating that Smith is of little precedential value. Instead, the court must focus on the purpose or intention of the taxpayer in light of all the facts and circumstances. The critical inquiry, according to the court, is whether the taxpayer had an expectation of profit. The court also talked about post-conversion appreciation, especially where the property is not rented. So is it being held for post-conversion appreciation? The Lowry Court also notes that the regs at 1.212-1B also stated that the term income is not confined to recurring income, but applies as well to gains from the disposition of property. It holds that Lowry is entitled to deduct his maintenance expenses, which was the only thing in issue here since Lowry forgot to claim depreciation deductions. It notes that Lowry gave sound and substantial business reasons for his failure to rent. It cites Newcomb with approval in stating that it does not regard renting as the litmus test for conversion. Note, though, that Lowry is probably narrowly confined to its unusual facts. Let's take a look at the problems on pages 464 and 465. In the first one, we're asked to recall the Frank case in Chapter 14. Should Frank's expenses have been deductible under 212 or 165C2? Well, this was discussed in the full case of Frank, but it was omitted in the casebook. The court disallowed a 212 deduction, saying that there's a basic distinction between allowing deductions for the expense of producing or collecting income in which one has an existing interest or right, and expenses incurred in an attempt to obtain income by creation of some new interest. The expenses in Frank fell into the latter category. The court went on to say that it might reasonably be said that the Franks were engaged in an active search of employment as newspaper owners, but that cannot be regarded as a business. What about a non-business loss deduction under Section 165C2 as a deduction for losses incurred in a transaction entered into for profit? Well, the problem here is that the only transaction entered into for profit in the Frank case was the purchase of the newspaper in Canton, Ohio, and that would be a capital expenditure. Other possible transactions were investigated and rejected or otherwise not entered into. It cannot be said that the Franks entered into a transaction every time they visited a new city and examined a new business property. The court also noted that it could not hold that the petitioners entered into such transactions, then abandoned them as they continued. Rather, they refused to enter into such transactions after preliminary investigations. Travel and legal expenses, therefore, are not deductible as losses because there's no realization event. In B, if Frank had decided to buy the newspaper and incurred capital expenditures to begin operations, but then abandoned his plans, would he have been allowed a deduction then? The answer to that is yes. Although capital expenditures would not be deductible as expenses under sections 162 or 212, nevertheless, the expenditures were made after entering into the transaction, and so they would constitute a loss, either incurred in a trade or business, or more likely in a transaction entered into for profit, even though the trade or business was not yet being carried on. The facts here are within the Domini case, which is cited in this problem. Domini allowed a deduction under 165C2 for expenditures made after a meeting of the minds with respect to the acquisition of a business in preparing to consummate the business. A deduction was allowed when the transaction was abandoned. The service agrees with this result in Revenue Ruling 77-254, also cited in the problem. It is arguable that the $1,000 of attorney's fees that the Franks paid in unsuccessful negotiations to purchase a newspaper in Wilmington, Delaware, ought to have been deductible by Frank under the rationale of Domini and the ruling. In C, if Frank entered the business and elected to use 195 but ceased operations before deducting all of his startup expenditures, to what extent could he take a 165C loss? Well, the remainder of the 195 expenses that had not yet been amortized would be deductible under 165C1 as a loss incurred in a trade or business, and that would be allowable under Section 195B as in boy 2. Problem 2A. We have homeowners who purchased a vacation residence for $180,000, $20,000 of which was allocable to the land. When it was worth $160,000, $20,000 of which was allocable to the land, they moved out and put it up for sale, but not rent, for $170,000. May they take deductions for expenses and depreciation on the residence? If so, what types of expenses would qualify? Well, the question of whether sections 212.2, 167A2, and 168C1B apply depends upon whether the property is being held for the production of income, as considered in the Lowry case. Now, Lowry, as distinguished from Horman, makes it clear that it is not necessary to rent the property or for the property to be put up for rent in order for those sections to apply. Whether those sections apply depends upon the taxpayer's intent, as determined by the surrounding facts and circumstances. The court will look at how long the property was held as a personal residence, and whether the taxpayer occupied the residence between the abandonment of the property and the ultimate disposition of it. It will also overlook the fact that no rental offers are made. However, where the property is not offered for rent, as in this problem, the principal factor relied on by the court in Lowry is whether the taxpayer intended to obtain a post-conversion profit on the property by holding it for appreciation and subsequent to the time the taxpayer abandoned it as a residence. And it does not matter that prior to such conversion, the property had declined in value. This is one of those unfortunate questions of the intent of the taxpayer after looking at all the facts and circumstances. Now, there is language in the Lowry opinion that the taxpayers must be seeking to sell the property at a price in excess of their basis, which would mean in excess of their investment, which would mean their adjusted cost basis. The concurring opinions in the Newcomb case, which was cited in Lowry, both attack that requirement and would require only that the property be held for post-conversion appreciation in value, not necessarily for a price in excess of its adjusted basis. The courts have not definitively resolved this discrepancy as yet, but the concurring opinions probably argue for the better result. The case of Hewlett P Smith, which the Lowry case cites, which I mentioned a minute ago, is more lenient in allowing deductions under such circumstances. In Smith, the taxpayers merely moved out of their old residence, acquired a new residence, and put the old residence up for sale, but not rent. They sold it after 3 years. The court found that during that period, the property was held for the production of income under sections 167A2 and 212.1, seemingly because it was simply abandoned and put up for sale. And the court did not appear to be too concerned about whether the taxpayer intended to obtain a post-conversion profit on the property. But more recent cases are not following Smith and have instead looked to the Lowry and Newcomb factors to determine whether the property was held for the production of income. Several more recent cases following Newcomb have concluded that taxpayers who merely put their homes up for sale were not attempting to reap a post-conversion appreciation profit on the property that would support a deduction for expenses. So 3 problems arise with the deductions here. First, if the post-conversion appreciation that's being sought must be appreciation over the taxpayer's cost basis in the property so as to produce some gross income, then the taxpayers here will fail because their sales price of $170,000 is less than their adjusted basis in the property of $180,000, even though it exceeds the conversion value of $160,000. Now that's not a good result. The test ought merely to be whether or not there is post-conversion appreciation. So appreciation over the fair market value of the property at the time it was converted. The second problem arises out of the fact that the property was immediately put up for sale. In Newcomb, the court states that the placing of property on the market for immediate sale at or shortly after the time of its abandonment as a residence will ordinarily be strong evidence that a taxpayer is not holding the property for post-conversion appreciation in value. Another case, citing Newcomb, held that where taxpayers inherited property, lived in it for some years, and then placed it for immediate sale but not rent, and subsequently reduced their sales price prior to a sale, the property was not held for the production of income. This case is Charles D as in dog, Mays, M-A-Y-E-S, at 30 Tax Court Memorandum, TCM 363, a 1971 decision. Lowry, of course, did not allow an immediate offer for sale to alter its conclusion. Now, the third problem here is that if these homeowners lived in that residence for more than 14 days out of the year, this is under Section 280A D1A, no deduction other than interest, taxes, etc., could be allowed in the year of the conversion under the general limitation of 280AA. The exception of Section 280A D4 would be inapplicable because the property was not put up for rent. This limitation would be inapplicable for years after the year of the conversion where no personal use is made of the property. If the property is found to be held for the production of income, then depreciation deductions will be allowed under Sections 167A2 and 168C1B. And maintenance expenses also would be allowed under Section 212.2. Now, there's several types of maintenance expenses that would be deductible, such as repairs to the property, gardening expenses, utilities, and other non-capital maintenance expenses. As the Harmon case points out, even if the property here were found to be held for the production of income, if it were subsequently sold at a post-conversion loss, the loss would not be deductible because there was no rental of the property and no Section 165C2 transaction entered into for profit. However, there might be an exception to that rule in an inheritance situation. Although a residence was actually rented, there's one case that denied a loss deduction on its sale. In that case is Henry B. Dawson, Jr. at 31 TCM 5, a 1972 decision. No conversion of a residence to rental property was found in this case, since the rental of the home to the purchasers was an interim measure only, as evidenced by the fact that the purported rental agreement and the purpose of the rental period was only to allow the purchaser time to obtain financing. Thus, the loss on the sale was denied to the owners since there was no transaction entered into for profit. Note that any deductions allowed here are deductible from gross income at arriving at adjusted gross income. So they would be deductible above the line under Section 62A4. Problem 2B1. Assume instead that the homeowners rented the property, properly took $10,000 of depreciation on it. What result if they subsequently sell the property for $145,000? Well, the homeowners would then have a deductible loss of $5,000 on the subsequent sale of the residence. The original basis in the property was its cost of $160,000. And after taking depreciation of $10,000 based on the property's fair market value, which was lower than its basis at the date of the conversion, take a look here at the regs at 1.167G-1. They would appear to have a $150,000 adjusted basis for the building and $170,000 adjusted basis for the entire land property, including the land. Nevertheless, they would have only a $5,000 deductible loss on the sale because the regs at 1.165-9B2 properly provides that if the fair market value of the property is less than the taxpayer's basis at the date of the conversion, the fair market value of the property, after making adjustments for post-conversion depreciation, is the adjusted basis of the property for determining loss. On these facts, homeowners' adjusted basis would be $130,000. That is $140,000 the fair market value less $10,000 of depreciation. That would be for the building, then $20,000 for the land would be a total basis of $150,000. Since the homeowner's amount realized is $145,000, they would have a $5,000 loss on the sale. So you can see here that what the regs do in using the lower of the fair market value on the date of the conversion, it allows a loss only to the extent that that property has been converted. So no portion of the loss can be attributable to the personal use of the property. Problem 2B2, what if they sell for $175,000? Well, if the homeowners sold the property at a gain, the regs at 1.165-9B2, that special loss rule on the basis would not be applicable. So their cost basis in the land and building of $180,000 reduced under 1016A2 by the $10,000 of depreciation gives them an adjusted basis for determining gain of $170,000. So on a sale of $175,000, they would have a $5,000 gain. What if they sell for $165,000? Well, in that case, they would recognize neither a gain nor a loss. So their basis for determining gain is $170,000, so they would have no gain. Their basis for determining loss is $150,000, and they would not have a loss. So therefore, they fall in between, so no gain or loss recognized. In 2C, what result in B2 if the property had been homeowner's principal residence? They had owned it and used it for 4 of the prior 5 years. So this refers us back to Section 121. Even if the homeowners met the 2-year ownership and use test as a principal residence requirement of Section 121A, the $5,000 of gain that we got back up in problem B2 does not exceed the $10,000 of depreciation allowed on the property. So the entire $5,000 of gain would have to be recognized as a result of Section 121D6. and it would be recognized as ordinary income. Although straight-line depreciation was taken, it is arguable that the property was held as depreciable property for less than a year, and the gain then should be Section 1250 ordinary income to the extent of the depreciation allowed. Next problem, 3A. We have single who purchases a principal residence after 2008 at a cost of $200,000. Prior to occupying the residence, single rents the residence for 1 year, taking $10,000 of depreciation on it. Single then occupies it as a principal residence, and after owning it for 5 years, sells it for $400,000. What tax consequences to single on the sale? Well, single would recognize $50,000 of gain. Single has a realized gain of $210,000 on the property. The difference between its $400,000 amount realized and its $190,000 adjusted basis after the depreciation is taken out. Under 121D6, single must recognize $10,000 of the gain because that was attributable to the depreciation deduction she had taken. In addition, single has 1 year of non-qualified use of the property over the 5-year ownership period, with the result that 1/5 of her remaining gain of $200,000 or $40,000 would not qualify for the Section 121 exclusion under Section 121B5. The remaining $160,000 of gain would be excluded under 121A. As a result, single must recognize $50,000 of single's gain. That comes from the $40,000 that has to be recognized because of the non-qualified use, because single rented that for 1 year. That was non-qualified use under 121, and then must recognize the $10,000 from the depreciation, which gives single a total of $50,000 of gain. In problem 3B, what tax consequences in A if single sold the residence for $600,000? So if single sells for $600,000, single would now recognize a total of $160,000 of gain. Single has a $410,000 realized gain, $10,000 of which does not qualify for the 121 exclusion and is taxed under 121D6, as we've seen before, because of the depreciation. Of the remaining $400,000 of gain, 1/5 or $80,000 does not qualify for the 121 exclusion because it's attributable to non-qualified use. As a result, $320,000 of the gain potentially qualifies for the exclusion. However, single may exclude only $250,000 of that gain under Section 121B2. So single must recognize $160,000 of single's $410,000 realized gain. Finally, in C, what tax consequences in A if single initially occupied the residence for 4 years, then rented it in the 5th year? So now single again would recognize the $10,000 of gain from the depreciation deductions. Single would again have a $210,000 realized gain, would have to recognize $10,000 under 121D6. However, going back to 121 and our discussion of non-qualified use, the non-qualified use rule would not apply, and the remaining $200,000 gain would fully qualify for the 121A exclusion. This is because the rental occurs after the personal use, not before. So therefore, our non-qualified use rule does not apply. So I'm looking at 121 B5C, 2 little i's, Roman numeral I. So the remaining 200,000 falls under the 250,000 exclusion and therefore would be excluded. For our last class, I would like you to, we're going to skip a couple of chapters, and we're going to go over to chapter 18, which deals with deductions for individuals only. And so what we're going to do in 18 is we're going to read the entire chapter except for the last subsection, which is E, personal and dependency exemptions. Those no longer apply because of the Tax Cut and Jobs Act. So therefore, no point talking about them now. I'd like you to read from pages 551 to 578. And I would also like you to take a look at the problems that are connected with those. This would be on pages 561 to 562, 563 to 564, 574 to 575, and then finally 577 to 578. So for our last class, that's what we're going to be skipping over to chapter 18 and doing all of 18 except for the last section, E, personal independency exemptions. So stay strong, stay well, stay safe, and I'll see you in the next and last class.